So you're finding it's almost like lottery tickets, not from the investor side, but from the issuer side.
Mhm.
And so we call that hot sauce. And that's stuff that you just, 5, 10% of your portfolio, go wild, just get crazy. And I think there's a legitimate lane in the portfolio for this because you do find a lot of people who might have a core that's set and they understand compounding. You got to wait. So they're like, idle hands. And so that idea of, packaging things to excite somebody or the opposite, calm them down is really interesting to us because you could sit there and outline why you should not invest in this, but psychologically that will overpower the logic.
All right. Welcome, Eric Balchunas to our podcast, to the ReSolve Riffs podcast. If you don't know who Eric is, I don't know where you've been hiding. I'll do a quick intro here. Eric is a senior ETF analyst and fund product specialist at Bloomberg Intelligence, and he's widely known as the Bloomberg ETF expert. He's covered the field since 2006. He's also the author of The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and saved investors trillions. This is a biography of Vanguard and its founder and the impact on the industry. He's also written the Institutional ETF Toolbox, published in 2016. Is that right? Um,
Something like that.
yeah. And then he's also a prominent voice in the ETF industry. You appear regularly on Bloomberg TV. You do Exchange Traded Fridays and the co-host of Trillions, the podcast, not to be confused by Billions. The
No, with that
horrendous,
title is
that
riffed off
horrendous
of the
series.
show because hedge funds, I mean, at this point, I think they
Yeah.
have 4 trillion, but they're taking in like, if they're lucky, 50 billion, 100, like it's very small. They're gonna plateau there for a while. Whereas obviously ETFs are,
It's
you
almost
know,
like the show should have been done at a completely different time when
I
people actually
you
cared about it.
can't make listen, you can't make a show about a passive fund company. It's just too boring. Nothing happens. You know what I mean? So I get why the show exists, but I will say that name of the podcast has aged well so far.
Yeah, it's looking good. I mean, the industry is growing in all types of directions, and we are just talking about before this call how what crazy directions the ETF industry is taking. So why don't we start there, Eric? What are you seeing, and what's kind of your view on how it's evolving in these crazy ways?
Yeah, so first of all, even though us in the analyst and media world, we tend to follow the shiny objects and the new stuff because it's new, right? Most of the money goes to pretty vanilla stuff. So investors aren't losing their mind. It's just that um, the core of the portfolio is hard to compete with, right? You got cheap beta, you got quants like you guys who have a brand name built up. If you want to launch a new strategy, a lot of people now are just looking to something that's like a structured product that has an outcome targeted, or hot sauce, which can be used in small amounts just to give you some fun on top of the portfolio. So we've seen a huge increase in the use of derivatives. Um, you know, I think 25, 30% of all ETFs have derivatives in them now that are launched. So a good example is the buffer ETFs. Think about this like you're old, you're a boomer investor or a silver, and you have a ton of money. And they have like 3/4 of all the money in America. But you don't have a ton of time and you don't trust bonds as much. And this thing's going to come along and say, some of them say there'll be no downside at all. It's completely protected on the downside, but we're only going to give you 9% of the upside. That's a, that's a pretty good deal. And if you're that person, you're like, you know what, sign me up. Cause they want to protect the money. Right. So that is a powerful concept. Now, if rates are 4 or 5%, you can get half that in a money market fund with like zero risk and still participate in equities. So there are some arguments against it, but this is part of what we think is the ETF industry producing things that help psychologically for people. So evidence wise, logic wise, you can say all you want, but at the end of the day, if you can cure a boomer's fears and worries and anxiety, they'll forego a lot and look beyond a lot of faults in that product or the downside or whatever. Um, and I think they're really truly okay giving up a good chunk of the upside. I think that's a trade-off they're happy to make. So these buffer products now have 50 billion. I didn't think they'd sell. I thought they were too complex, but now when you realize how I just put it to you, I'm like, "Oh yeah, I get it." Advisors have to deal with the emotions of their clients. And then on the flip side, you've got products coming out to stimulate, usually younger people, double leverage NVIDIA. Like, it's crazy to think just saying NVIDIA, it's a $5 billion ETF.
It's crazy, and the what is that? The
Th
triple leverage China as well now? It's some
Yeah,
crazy.
well, that one's been around a while. It's just having a moment now, but the single stock leverage is really interesting to me because, again, I thought they'd be like 200,000,000 and traded by a real small group, but 5 billion. And the genius part of it is they charge like 1 to 1.2%. It's over 1%
Oh
fee.
my god, no, I saw that, I saw it. I saw the 5,000,000,000,
So
I saw the 1.04, percent management fee.
and if you can just get a couple
Unbelievable.
people in there and NVIDIA will do a lot of work for you, because the 5 billion isn't all flows. A lot of that's from NVIDIA going up and it compounding a little. I get it. So you've got these people who were used to be like the guy who launched the 2X NVIDIA used to be a gold guy. He was like the GLD guy. Then he launched commodity ETFs. But then he got into this, this more exotic area, defines the same thing. So you found people who otherwise were more long only types sort of gravitating towards this because all you need is like one hit. And with that fee, you're set. So you're finding a lot of it's almost like lottery tickets, not from the investor side, but from the issuer side.
Mhm.
And so we call that hot sauce. And that's stuff that you just, 5-10% of your portfolio, go wild, just get crazy. And I think there's a legitimate lane in the portfolio for this because you do find a lot of people who might have a core that's set and they understand compounding. You got to wait. So they're like, idle hands, and so that idea of, packaging things to excite somebody or the opposite, calm them down is really interesting to us because you could sit there and outline why you should not invest in this, but psychologically that will overpower the logic.
Yeah.
Eric,
And
how much
it's
of
interesting
the
to
of
me.
this diversity of new offerings, like we talk about the buffer ETFs and satisfying the boomer desire for some stability of the returns that they're hoping to generate, how much do you think this is driven by the perceived failure of the bond sleeve of portfolios to provide that buffer in like 2022, 2023? And, we've seen a little uptick in bonds over the last 6 or 9 months, but they're no longer perceived to be that safe, stable source of stability in the portfolio, right? So, how much is that driving it, do you think?
This is a great point, and this opened the door for all this stuff to a degree. I still think the thing I just mentioned to you is pretty appealing, but it's extra appealing when you have a boomer who just went through 2022. They see their stocks go down 18%, 19%, and then they see their bonds go down 13%. It's the 40 is supposed to protect the 60. Like it's just that's how it's always worked. But because the Fed raised rates to fight inflation after having lowered them to stimulate the economy and the market, it just became like this Fed controlled thing. So the 60 and the 40 now goes up together or down together simply because it's Fed controlled. In 2008, stocks went down 35%. The ag, I think, was up a little bit, but was really up was Treasury. So, like you had TLT was up 35%. It completely offset your stocks. This is what people are used to. So when you have, I mean, the ag is mostly Treasuries. That just is shocking. I
Yeah.
think so. If you can't trust the bonds, then you're definitely going to be a little more open to be for something that can help again calm your nerves because you have made a ton of money. And I think most boomers understand how lucky that they've been. They've sat through these like this mega bull market, and They don't want to lose the money now. And so, but they're also like, I just think that the investors who made all the money in the stock market, there's a such touch of greed. They just can't take it all and put in a money market
Yeah,
fund and
like
get
they
5%.
know that they've made money. They're in the casino. They're on a roll. They're in the
Yeah.
blackjack
So they
table,
can't
whatever
leave.
table they want, and they know they should leave. As their wives are pulling them and saying, "We gotta go," and like just
Yeah.
one more
I
roll,
know.
right?
One
Just one
more.
more roll.
I
And I
know.
think a lot of these, buffer these kind of, the ability to add an extra 5% in the 2 times leverage single stock, so you can tell your buddies conversational alpha stuff that we talked about last time.
By the way,
I think
I've
it's
told
still,
that story.
yeah,
I bring up that phrase and I go, listen, if you're sitting there going, WTF is this bullshit? I'm telling you, this is a normal reaction. And I brought up, I was on a podcast with some really smart quants and their heads exploded. They were like, what are you talking about?
yeah,
It is, it is a controversial term and you're not alone.
yeah,
The people who are into it though, they're into it.
yeah.
But the, like a normal, trained investor, they don't, they're like, what are you talking about?
Yeah,
But
and that's the thing, it's not about getting off the S&P 500 train. It's about continuing to ride that train, but maybe offer a little bit of downside, right?
yeah,
Like, that's where the most I've seen really get to, rather than examining what last time the correlations between equities and bonds were high, which was in the, 66 to 82 period, and seeing, "Oh, there are other things that actually we should be investing in or looking at, like gold." And if tips would have existed, they probably would have been a good option, amongst other commodities or commodity driven economies. But we haven't, nobody's invested. No, nobody can remember what it was like to invest prior to 1981, right? So now all of a sudden that we
yeah.
see that the other option is the fact that we now have many more options to hedge against that inflation risk, and they're coming in all shapes and sizes. So, what are you seeing as the biggest drivers of those? Uh, what type of themes are really making a heyday out of this particular circumstance?
Well, the buffers certainly, those are the most direct.
Yeah,
It's like, "Hey, look, 0 downside," or "You take the first 5%, the options will cover the rest," something like that. Um, and also, by the way, when BlackRock launched buffers, that's when you know it's like, it's real. It's just and if Fidelity launched some, so the big guys are that means their wholesalers are coming back and saying, "We have to have these."
right.
Um, other is the covered call. This is a whole thing. So, like, these used to be called covered call, now they're called equity premium income. It's like the new tuxedo poo name for covered call. So those are, very popular. JEPI is the big one. JEPQ though I think JEPQ is 18 billion. JEPI is 35. JEPI is the biggest active equity ETF on the planet now. Um, and JEPQ is probably in the top 5. Short of the Bitcoin ETFs, JEPQ is the fastest ETF to reach 20 billion, I believe. Yeah, so JEPQ has over 20 and,
And
it
What
is
is that?
crazy.
What is
Je-
it again? What
that is
Sh
the equity hedge
16
ETF.
billion. Sorry, JEPQ is the fastest to get to 10 billion. Uh, the Bitcoin ETF beat it, but besides Bitcoin, the JEPQ is the fastest ETF to 10 billion. So all it does is there is a fundamental screen in there, but I don't think that's what people are buying it. They're really buying it to have the S&P or the NASDAQ, but with call options written somewhat out of the money where you get like 9-10% dividend yield, right? Because the option premiums comes and gets back to you as so A, people like income, and B, you have a little bit of buffer because the income acts as like extra return, right? If it's going down. But the problem is in an up market, you lag. So
What's
JEPI
crazy,
was
Adam, about this is I've replicated the performance almost to a T using, I think, I don't hold me to this, I did it like 6 months ago, but I think it's something like 60% S&P 500, 40% cash gives you the exact same performance as JEPI. Right? But there's just something sexy about saying we're going to get exposure to the S&P 500 with these covered calls, and there's this
yeah,
yield, but it is in a very expensive, massive fund that everybody loves. Every time we talk about our products, they say, "Well, what do you think about this deputy?" It's just S&P 500 plus cash. There might be some differences at the tail ends, in like the worst part of 2020, but it's bonkers. Again, like, I mean, it doesn't matter. This is about conversation and positioning versus reality.
Sure. Yeah, and that's, talking to people like you is where I do focus on the word psychological. And I keep thinking about this more and more. And I just think like that that's where a lot of people currently in proverbial labs are trying to find the next wonder drug. Um, and that's a big part of the products that you see coming out. There'll always be some people competing for the core. We have GMO at this panel tomorrow, and they're not doing anything weird. They're just like, we do our thing, but they have a brand. So if you have a brand, I think you can maybe like, keep some of those customers and just hang on. But a lot of these are firms looking to innovate in some way. I mean, JEPI is a JP Morgan mutual fund based on the mutual fund. But to JP Morgan's credit, they did price it at the R6 level. A lot of mutual fund companies come into the ETF world and they price it in between the I and the A class. But R6 is even below the institutional class. So it's a 35 basis points. The advisor feels like they're getting a lot of legwork out of it. And it's a huge hit. So Goldman and everybody else is now copied with these equity premium. Then this new firm, Yield Max, was like, why don't we just move instead of being out of the money way out here, let's go barely out of the money, get a crap load of income, and we'll give it all back. It's almost like stealing from your NAV to give you income. I mean, so
There's no almost about it.
but they yield 100%. So you get this big shiny number. And we just interviewed a guy for the podcast, and he claims they're qualified, and he's able to use the income as like to show his bank that he has qualified income so he can get a mortgage for his house. So there is some there's these under
Wow.
these
All these
use
things are
cases,
structural reasons why these are attractive. That and
psychological and structural.
from a pure
Yeah.
investment lens, doesn't make sense, but maybe
Yeah.
there's something there. Yeah.
Yeah. I mean, there's, like I said, we talk about these products, but even buffers are 50 billion. That's 0.3% of all ETF assets. The Bitcoin ETFs, they are 60 billion, again, 0.4%. So the bulk of the money is still in pretty much long only stuff. But something that has 50 billion today could have a trillion in a couple of years. So we track them early because these are swells, they turn into waves. And also, if you do this every day and it's your job, when something's new, you're like, okay, what's going on here? And then we get the bigger firms jumping in. You're like, okay, BlackRock's doing it. I mean, that tells you the wholesalers came back to management and said, all the advisors are asking for this. Unless you want to give the money to JP Morgan, we need a product. And so they launched the copycats. That's usually when BlackRock or Fidelity or State Street gets in, that's when I'm like, okay, it's legit. So even like BlackRock launched a B level CLO ETF. And I remember Larry Fink like trashing senior loans back in the day. But that's how you know CLOs have arrived, because they have the A now and the B, because Janus basically has a mint with their two products. But it's hard to get
When
a
they
billion.
launch the equity tranche ETFs, you'll really know that we've dug to the very
Well,
bottom of the
the return.
credit
I would
stack.
give the return stacked ETFs there's something going on there. You guys have good assets for the size of your firm, and the idea you have to explain this to somebody. So watch out. Here comes iFears.
But it's the
They may be.
variation on the theme, right? I mean, it's continue to see more sort of examples of. I mean, how many ETFs did you say have launched so far this year?
About 520
And what's a
and
typical year
420.
in a whole year?
Yeah, the whole year. So basically, on average, about 1.3 ETFs launch a day, 1.5 in a good year. This year, 3 are launching a day. So we're at almost double the pace of ETFs per day, 3 a day. Globally, it's like 8.
And it's this search for diversification.
Search, search for the holy
Obviously,
grail.
it's not the only driving force, but the search for diversification other than bonds is a big driving force.
Sure.
And as a result, I think so a pretty big chunk of these new ETFs are using derivatives, right?
Yeah. Well, yeah, the ETF rule allowed, which was like 6 years ago at this point, I think, allowed for derivative usage in a more liberal way. One firm that jumped all over that was Simplify, but they're not alone. So you have a lot of these firms who are now really, it's using derivatives. I'd almost argue is like you're painting with like 6 colors, but then now that you can use derivatives, you got like 50 new colors. They're all like,
Yeah.
they're not the main ones, but they allow you to really fine tune a vision. And so the issuers are now basically trying to figure out all these designs. I heard somebody's going to try to merge the covered call with the buffer. Just try to just, hey, why not? Peanut butter and chocolate. Let's go. Uh,
That, that birth child is going to be something to behold. My God.
well, you know what's
And
funny?
it,
The biggest buffer ETF is the one that just puts them all in one. So it's got like it's like all the buffers. So it goes out and buys the buffer ETFs for you. It's like a buffer of buffers.
the hyper buffer, the meta buffer.
Yeah, it's the
Um,
first trust um, laddered buffer, 5.4 billion, and it charges 1%. And that might be, I would hope the underlying ETFs fees are included in there, but I'm not sure. But the Innovator and First Trust, the two biggest issuers in the buffer, their fees are 90 to 100 basis points. That's another reason. If someone finds success in a Vanguard free zone, the word gets around a little quicker, I think. Then, like if GMO has some success getting their like quality ETF some flows, people are like, well, it could be their existing clients. But if somebody finds success somewhere out there, people are like, oh, wow, and you're going to find a lot of product. Then the salespeople are going to figure out how to sell it, and you'll find some buyers. So, um,
Eric, what do you think's motivating this wave of active ETFs that are launching, like active equity ETFs? I mean, this is a period where passive has beat active by epic levels and at like epic frequencies, right? Like only a vanishingly small fraction of active managers in the US large cap space have delivered any value above the cap weighted index over 1, 3, 5, 10, 20 years. So what is motivating or giving confidence to these active managers who are launching in that very market segment?
so when we talk about active, so 3/4 of all ETFs launched this year are active. That's a lot. That's like four something hundred of the 515,
Right.
520. But let's break this down. 20% of that is buffers. I wouldn't call those active. They're
Well,
active technically, but not like your grandfather's active.
right.
Then I would take the single stock ETFs out. They're also active, but technically. Then you're left with a good chunk of traditional active. Okay, why are they selling? Okay, well, we looked. I think advisors do want to differentiate. I think they're like, I don't want to just hold 3 Vanguard funds. I want to actually add some more value. And what happened to the active funds, Avantis, DFA are probably good examples. Capital Group's another. You've got these firms, and even Federated came out with they're taking their mutual fund active that maybe some of the clients know. Oh, I know who Capital Group is, but they're giving you the institutional fee, so they're charging you like 35. So a lot of traditional active that you used to buy for 80 is now like 35 to 30. In a DFA and Avantis' case, their fees are down to like 15, and DFA has one under 10. And I think for advisors who are cost obsessed, but they also want to tell a story. I think now that you have active bringing their fees down a bit to compete more with smart beta and even passive, you've got the fee check. It's like, okay, it's cheap enough that I feel like I'm getting a good deal, but I also have the story. So I think that's part of it. Avantis has this one ETF, this AVOV. Maybe you guys have some comments on this. The performance has been crazy. I mean, it's basically doubled like the small cap ETF. Might have even doubled the small cap value benchmark, Russell small value. It's the biggest small cap value ETF all of a sudden. It somehow passed Vanguard and iShares. So it did it through its low cost, and it's in a category maybe where active could find more opportunities, I guess. But the performance was good, and that got around. I think Morningstar probably gave it a good rating. So AVOV, and this is pretty impressive because small cap value has been out of favor, but AVOV right now is 13.8 billion. That's a ton to come out of nowhere.
Yeah.
We launched 5 years ago. It's 25 basis points, but it's in fact, at one point it was beating the S&P. And I was like, how the hell is a small cap value fund beating the S&P? That's how good the performance was. So I would call AVA a little arkish in that it's got this shiny object moment.
Mhm.
That certainly helps. So overall, though, I think Capital Group lowering their fee to like the I class of the mutual fund and those kind of big firms, Fidelity, Federated, once they finally got like the upper management to agree to a lower fee to sell to advisors, I think you do get some advisors biting on that because they want to they I think they want the portfolio to be a little more than just two funds. They want to add this, that, and the other. I also think 2022, stocks and bonds did go down, and that 2022 value rally caught everybody by surprise. But I I think that's where 2022, I think, scared people on a variety of levels. But I think the story that the Mag 7 could like really go down quickly is something that active managers are trying to present, which is because I think everybody with like, who has a common sense is like, yeah, the Mag 7's like really probably overvalued. So let's have an active manager pick stocks that are a better deal. So I think between all that, you're getting some takers. And remember, there's a lot of
Yeah.
friends and family with these firms. Like Capital Group salespeople are friends. They go golfing and like they just know all of these advisors. That matters too.
Yeah.
So that's why I think it's finally starting to sell. But I think all that doesn't mean anything if they're still charging like 90 bips for slight tracking error active large cap. But now that it's like 15 bips, now more the advisor considers it.
Right.
I made this chart showing active share and fee. And if you draw a 45-degree line, the top 10 most successful active equity ETFs are all above the line. So even an ARC, which is real expensive but high active share, as you get down, JEPI is like in the middle, and then the lower end is Avantis and DFA. So as active share comes down, your fee sort of has to too. And to me, this is almost like just charge me for the active because beta can be gotten for free.
Yeah.
So in your question, I do think the rise of passive, even if they're not buying passive, it has had an impact on these other areas. And it's sort of I always, and in the Bogle effect, I think that beta being free is a big bang event that everybody has to orbit around now. You have to deal with how to deal with this. And if you are giving mostly beta for a high fee, that's the endangered species, I think. Barring any like first trust friends and family where they're able to just get flows into anything no matter what. Um, it, but most of these new products are adjusting. They're either going high active share or low active share, but lower fee.
Yeah. So
What
I
on
think,
the
oh,
international? Go ahead.
so I just want to I think what happened in 2022 as well is you had massive dispersion of opportunity sets, right? You certainly did see passive do the same thing. So there was no dispersion there. Bonds, equities moving together. Anything that's passive kind of lost around the same amount. And then you saw big outliers in the double digits positive returning years. Like, managed futures did really well then and after, right? You did see ARC get really hit. It had its heyday the previous 5 years, and then it was the worst hit, I would say. And so the recognition that it's not a forever thing, it's not a this time is different thing, and being able to clearly see, okay, wait, there was dispersion. What was that dispersion? Who made a lot of money? And then trying to understand why has driven a bit more of an interest towards active. Uh, and of course, the only way you can get that level of dispersion is if you have a lot of active share in stock selection. And then on the derivative side, just what was different, right? So being able to see it clearly, we've been talking about it for 15 years. That one day that'll happen. Nobody cares until it actually
It did
does.
happen for one day.
Right. So yeah, I think active. I think a lot, like you said, there's an aftershock from ag going down at the same time as equity. And I think the aftershock has left an opportunity set there for active that'll maybe even last, longer than we think. Maybe we get into a decade of active from here, but who knows?
Yeah, I mean, if you look at smart beta, remember that came out, it was only like power shares early.
Yeah.
It didn't do that much damage, but it slowly got cheaper shiny, and then it became a hit. Same with ESG, although that's kind of gone to the wayside. But when ESG did get popular, it was only because BlackRock and Vanguard came in and sold it cheap. Um, the advisor world is just very cost conscious. And so I just think if it's the core, if it's something that's like low tracking error or literally the index, they demand lower fee. It's something to add on as a little spice. They have more budget to spend out there. Plus, with the shinier stuff, you can not just beat the index by 2%, but maybe like 300%. Um, and so that's why I think you see, or our ironic theme is that the more the core gets boring, the crazier the new launches will get. Like the more passive takes in flows, you will see an ironic byproduct of launches getting really way more creative, to be nice, creative. So, yeah, because funny, I was looking at the biggest ETF hits from the last 5 years. And besides the Bitcoin, all of them are like JP Morgan, Capital Group, DFA. They're all active, kind of traditional active too. So, and if you go 20 years, you're going to see all iShares and Vanguard. So that tells me that active will have a long runway. I also think there's just a lot of people in the mutual fund wrapper that are clients of that firm. Maybe they don't even understand what they're even in, but they're going to try to move them over to the ETF wrapper. So there could be a lot of flows. Like DFA is a good example. Like if you look at their flows in the ETFs, it's almost the exact amount that's left their mutual funds. So that said, if they were trying to move you into something that was more expensive, people might not go. But so the fact that the ETF is as good or better deal, I think makes that transition to the ETF better. So I'm not saying it's not worth anything, but Vantis, meanwhile, everything's new because they're a new company. Um, Capital Group, hard to tell, you know, but they actually did better than I thought when I looked at their 5-year flows. I thought they were just going to be an outflow city, but they hold up pretty well. They're the biggest active manager. They have like, I want to say like 2.5 trillion or something. They have a lot of active money. So a good portion of that's going to end up in the ETF wrapper. So as we see active grow, not all organic hits, you know, a lot of it's going to be like that BYOA money coming over, I think.
Yeah, just move from one
Yeah.
structure to another structure that's
But a save
just
is better than a loss.
right.
Yeah.
Even though you're taking a hit on your fees, right?
Better than
Um,
dying. I think
yeah, so
that's
your
a
margins
lot of them are
are
coming around to, I think that you, I think a lot of medium to big size firms, small firms. And when I interviewed Bogle, he said the same thing. He goes, small firms, whether it's advisor or asset manager, they're usually fine. They somehow can just live underneath all these tectonic shifts because they usually have good relationships with their own clients, have personal relationship. He's like the mid and big ones are where you're going to see a lot of consolidation. And I think in this, if once we finally get a bear market and the bull market subsidy stops lifting, like the Fidelity Contra funds assets go up every year, even though it sees like 40 billion of outflows. Once a bear market hits it, I think if you don't have some kind of a stake in the ground on the ETF side that's growing, I think you'll probably just be like a takeover target. You know, um,
beer market,
that's
you
my
say?
guess.
Is that like
Yeah,
the Snuffleupagus' brother?
what is that? Yeah. Okay. Well, what was that word you said? Yeah. No, I, maybe I was somewhere like last week and I said, but I don't know, maybe we'll never see one again, because I'll, there's I'll put my tinfoil hat on for a second. So there is a decent theory that, how COVID hit and the market goes down and the Fed buys bond ETFs and the market goes back up and we're good. And then even in the 2010s, like the Fed's kind of bailed out the market a couple times, even if it was just a word, like the Powell or Yellen would say just a word and the market would be back like, okay, we're good. Sugar daddy's behind us. The people who are running all the institutions like the Fed, they're all boomers and silver, and all of their retirement money is in the market. And so they have the most to lose if it goes down. That's one. But number two, there's also this like revolving door. So like a lot of people from PIMCO and BlackRock work at the Fed and the Treasury and vice versa. And they all pretty friendly. So I think, if you have a massive sell-off, it's very possible someone from one of those firms calls and says, we're about to have a liquidity event. You want to run on mutual funds? Then fine, don't do anything. And it's almost, so we actually had a theme 2 years ago, it was out of COVID, that we think bond mutual funds in particular are like too big to fail. Because there was a point when the the selling was getting so great, you saw it in the discounts in the bond ETFs, that and there was one or two bond mutual funds that the NAV went down like 30% in a day because they were having a run on that. And
I remember.
well, that was a canary in the coal mine. And the PIMCO income, which is the biggest one on the planet, went down 12% in a month. And it saw 15% of its assets leave in a month. So do the math. You only need like another month that before you have to stop redemptions. And then India, where they didn't do this, India's bond funds had to freeze. Franklin Templeton froze a bunch of bond funds. So the question is, if we get into a 2020, uh, you may have to just let the bond mutual fund implode and have people won't be able to get out. That almost puts that almost tells you the Fed put has to exist
Well, that's what
because
they're there for. I mean, the question in those particular moments is whether that's a structural issue, a long-term, structural issue, or a momentary structural issue. And if it's momentary and the Fed can add liquidity in order to make sure that it doesn't blow up, they're always going to be there. That's kind of their job, is to keep stability in pricing, right? So I would imagine, and especially now, so coordinated, the amount of interventions are much higher than we've ever seen them. They're likely to be there over and over and over again. So I wouldn't.
well, then you're likely not to get. That's why you may not get a bear market. You just may get a crazy day or two where the shit hits the fan. It goes down 10%, or there's a limit at 7, but it goes down like 7, and then boom, the Fed steps in, and then it rips higher, and then we're back to like this sort of placid, rather than like a 2000s. I mean, there was 2 shock events there too, but like, I don't know. It's interesting conversation, but if a fund cannot be hit hard enough where it has to freeze redemptions, um, I don't know how we get to a bear market
Well, it depends on
unless
how you
it
perceive a
had
bear
slow
market, right?
motion.
I think
Yeah, I would
you
say, how
can
about this?
what you're talking about, and what I agree with, is that not notionally you're going to have, over the nominal exposure of bonds needs to have a constant bid. The world needs to see an equity line from bonds going up. They need to see an equity
Yeah,
line from equities going up. But if you were to look at the real return line of bonds, it continues to be in a massive bear market, right? Like
yeah.
Well,
the actual return of your
Well,
product.
sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investresolve.com. Now back to the podcast.
so speaking of the revolving door between private sector credit funds and the Fed, um, what's going on with this new private credit fund launched by Apollo with State Street sponsoring?
So look, a lot of issuers have tried to fake put privates in ETFs. We actually wrote saying, you just can't do it. This is one thing that's not ETFable. Let's just all live with this. But, they're always going to try. The ETF market is like the Silicon Valley of the asset management world. They're just going to keep pushing the technology as far as they can go with it. Well, this filing came in from State Street that was a novel approach. The other ones that came out would they'd buy like microcaps and be like, well, microcap stocks have the same attributes as private equity, but I call that fake. Okay. So this one is a little closer to real. 15% of this fund will be in actual private credit.
15, right?
15. Well, there is some debate on whether you can go higher because it's a long story on what, you consider liquid. But for now, let's just say my guess is it will be a portion of the portfolio, not the whole thing. And Apollo, whose name's on the fund, by the way, is important. They're going to provide the liquidity backstop. So they promise to buy all the bonds back in a sell-off. They'll have bids and asks and work with the market makers and APs for the private portion. The rest of the fund will be like high yield bonds and other publicly traded bonds. And this is novel because you're bringing in a legit private credit issuer, I mean, company, and they are willing to put up that capital and
Now,
provide that
Eric, are they
assurance.
promising to put up that capital from Apollo's balance sheet, or are they saying that we run a variety of other private credit funds, and if there is a liquidity issue in this new ETF, then some of our other funds will step in and absorb that?
I didn't see anything about other funds, so my guess is that it could come from that. My guess is that I think Apollo's like, look, if there's a huge sell-off in private credit, that's like the best time to buy. So they're probably like, yeah, we'll take it off your hands at fire sale prices. So I think that's one reason they came to that conclusion. The other is the guy who is the CEO of Apollo is Mark Rowan, I think it's his name. There's a good interview that with Jonathan Farrow that just got put up like 2 weeks ago. I would listen to it. He he says private credit is not as illiquid as people think, and public credit is not as liquid as people think. And he thinks like in Australia, you can get private credit in the retirement plan there, and those returns have been great. So this guy has big plans and vision to bring private to retail. The reason that matters is because they're huge, and if they're promising that, then it it answers the question: how do you make something illiquid liquid? Well, you have somebody who promises liquidity. Whether the SEC says yes or no, we'll see. BlackRock also bought Preqin, which is another move, and Larry Fink has said we want to democratize this. I don't know if that means the ETF or not. My guess is after seeing this filing, they're going to have something brewing. Now, everybody will say, well, you should put all this in an interval fund, where you can only get out every quarter.
Mhm.
I get that, and more power to people doing that, but like nobody wants it in that format. It'd be like putting up your latest album on an 8-track cassette tape only. Like who would do that? Like there's a couple like, nerds who like care that much, but no,
Are people?
they just don't want it in that format. And so they want it in the ETF format. And I have this note that I feel as though ETF investors over the years have the ETFs have built up so much trust in the, with the investors and the traders that even when there's a huge discount in like a bond ETF, I think they trust the price of the ETF more than the NAV, which honestly they should. A lot of the NAVs are just not quite up to speed with what happened. So there was a case of the Van Eck High Yield Muni ETF, HYD. It traded at 20%, 29% discount during COVID. Today, since then, it's taken in $1 billion of new cash. It trades just as much as it did. Like nobody gave a shit. So I think that's crucial because you could so even if 15% never trades at all, I'm going to leave it to the APs and the market makers to figure out something to proxy. And they're going to let the arbitrage band stretch till it's profitable for them. But there will be a point where they'll arbit. And I think that the end investor trusts that process to play out, and they're happy getting the price minus whatever the arb people need. And I think that's why it'll succeed. And I think there'll be others to follow, and why it's a little disingenuous to say you can't put anything illiquid in an ETF. I mean, every day the Japan ETF's illiquid. There's been the Egypt ETF was trading for 3 months during the Arab Spring, where the stock market was closed. Um, so there's plenty of cases of this, and obviously the COVID was another one. And you can tell, like, nobody's turned off by this. These funds do the same volume or more, and everybody moves on. So I just think this is the vehicle people want, and they're ready to trust the price.
It's funny that it's the vehicle people trust and ready to trust the price. You also have those single stock foreign
Yeah,
ETF
those just launched
reference.
today.
You can buy your ETF. You can buy the security, but why do that when you can buy an exchange traded fund and do the same thing? Like, what the hell's going
Listen,
on there?
single stock ETFs, literally an oxymoron. I mean, it's like jumbo shrimp.
But it's not even. Are they two
Just
types levered? Are they just single
no.
exposure?
Okay, they do have a twist. The single stock NVIDIA isn't just NVIDIA, it's 2x and inverse. So you do get something on the
Yeah,
side, something extra.
yeah,
These are currency hedged ADRs. So they take, if you look at like Shell, which is a UK oil company or whatever, the London based ticker is up like 50% in 10 years. The ADR is up like 35% because the
right.
dollar was strong. This gives you the 50. So it basically, it's like DXJ except for one ADR. So will these be a hit? I don't know. But
Does the currency hedging for you on single stocks? Amazing.
yeah,
Yeah, that's something I
so
never thought I'd see, to be honest.
I didn't either, man.
The other one I didn't
I'm
think I'd
liberal and I
see.
sometimes am surprised.
The other one I didn't think I'd see coming back with a vengeance is that CLO market. Why don't you tell us what's going on there?
Yeah. So people don't, I was looking the other day, if you look at the top 10 issuers by flows this year, the usual suspects, BlackRock, Vanguard, JP Morgan, Fidelity's on there. They're not totally on there, but that's still not that surprising to me. But in ninth place is Janus, which, I was like, what, and lo and behold, this CLO ETF they have, JAA is the ticker, is,
Yeah, man.
yeah, I know. I think of John Morant, but there's a lot of things that come. Anyway, 13 billion. And this launched 4 years ago.
Crazy.
That's a lot of money for something that just came out. Now they launched JBBBB, which is triple B to B. It's like single B to triple B. That's 1 billion. So to get 1 billion in a B CLO alone would, even if they got billion in the A, I'd say that's pretty good. So the thing is, if you chart these CLO ETFs, and you guys will appreciate this, it just seems like an institution's dream. Like you
I
get
was going to say whether this is
the
mostly
returns.
institutions.
I think so, or advisors being like, I want what the institutions have. But most advisors just don't care about Sharpe ratio. Like they just, the ones you deal with are probably more sophisticated. But I found that like risk adjusted return sometimes doesn't, you can find a fund with like really good risk adjusted return. It just doesn't move as much in flows versus something that's like cheap or shiny. Anyway, these things have like good returns, almost no volatility, and no correlation. So they check a lot of boxes for a solid alt. And I didn't appreciate that until we had on the show when I charted it. I was like, holy moly, there's some good numbers here. Now, this is the current, it might change in a different environment, but in this environment we're in, the numbers these things are laying down are really, they're attractive.
Yeah. I mean, attractive enough to attract 12 billion, $13 billion.
Yeah.
That's crazy. So I do want to pivot a little bit into Bitcoin and crypto. It seems to have a bit of a resurgence, right? Coming back from the bottom. Now we're here at almost 70 again. How do you see the ETF world of crypto growing, and what's new and exciting in that space?
So everything I just explained to you about like the modern portfolio and like, okay, I've got my serious stuff. I'm going to wait 30 years, whether that's a quant approach or beta passive. The key is we got to wait, right? Even like factors, you got to wait it out. So people are like, great, but then they're like bored. So, and I think that this would go it fits in the hot sauce bucket perfectly. It's something that's very volatile. To me, it's like young gold. It's like gold as a teenager. This is like what, 20 years old, 18 years old. Gold's like 4,000 years old. Same purpose, store value against a declining dollar. And it's pretty simple message, but it's got the volatility that can excite you a little to fit more in the hot sauce bucket versus an alt. So to me, people are using it more as something to spice up the portfolio and to cure future FOMO because they're like, I don't want to kick myself if it goes to 1 million because that happened last time. And now that it's an ETF, I don't have to like deal with all the bullshit, the friction of like getting your own wallet. You just click buy and this is BlackRock or Fidelity. I trust those guys. So you got brand names involved, low fees. They're all 20 to 30 basis points, high liquidity, and this practical place they fit in the portfolio, which is the spicy side. So to me, I could see a lot of people doing 1-2% allocation in these. So it's not a surprise to me that they're successful. That doesn't necessarily mean that it will go to $1 million, but 63,000 is pretty good because there's a bunch of dumps that happened in the past like year, and it was trading at 30,000 when the BlackRock ETF filed. So you've gone from that BlackRock filing to 63, and that's with some dumps. So the ETF, I think, has really, in a way, just revitalized Bitcoin, I think. And I was just looking at something last week where Jay Jacobs, who's a really polished salesperson for BlackRock, he is out, he was giving a presentation to their clients on digital assets, and he has a huge chart of the decline of the purchasing power of the dollar. And you just got to stop and remark on this moment that, like, here's the biggest asset manager, basically with a message that just comes from like the corners of Twitter. Do you know what I mean? And for those kind of firms to adopt this, and then Larry Fink goes on Fox and says, if you don't trust your government or you think they're going to like destroy the currency, this could help. They've gone a long way. And that's going to provide good amount of cover and convincing for some of the intermediaries out there. So I don't, whether you're bullish on it long term or not, it's hard to be bearish on that, which is these firms who finally have a product that like Vanguard doesn't compete in and they never will. We can get a little thing going on here. Let's pour some resources behind it. And of course, the people who are buying it, the intermediaries and even retail, they were getting screwed on Coinbase with commission fees. Sometimes some of them pay like over 1% just to do a trade. Well, the ETF's 1 basis point, so it's 100 times savings, right? And the expense ratio is only 20, 25 basis points. I think for the amount of outsourcing you get here, I think they're like, this is a really good deal. So I'm, but still 60 billion is 0.4%, 0.5% of all ETF assets. But to do this in 9 months is absurd. Like the numbers were ridiculous. A lot of records were broken. So, I think a new category has just been born. It's going to be like adjacent to gold. I think they'll both be like equal assets someday, and that'll be that.
Funny you should say that.
So,
Bitcoin and gold, eh?
uh,
You doing a combo? Oh, that you
Uh,
have one. Did you launch it? What's the ticker?
I'm trying to figure
Don't
out
say it.
what I can say about it.
I don't think
We
we can
can't say
talk about it
much.
now.
We'll just leave that there for now. But yeah, that's I'd certainly
Matt
like.
Hogan
Look,
wrote
I was
something about
looking
that.
at that chart that you showed of the depreciation of the dollar since 66. But the depreciation of the dollar since 2020, like your purchasing power all in is gone down around 20%. And in Europe probably more, right? So that's a modern day, a last 4-year type phenomena that those prices aren't going back down again. This is the thing. Like things got expensive, and it's not like when inflation goes away, we're going to get cheap again. We're stuck at new levels. So this idea of hedges to that, whether it's commodities, gold, and Bitcoin, I think are going to continue to be in the zeitgeist as more and more interesting topics to explore.
Absolutely. I think that's the serious thinking person's case for it. Curing future FOMO is just to add on, but I do think there's some of that. The Jake Economic Pick put a good chart out. Speaking of ag, that over 10 years, the ag has not kept up with inflation. So you lost real returns. And again,
That's
that
your
also
market that I was
makes for a hedge. So, but the haters, if it doesn't like hedge inflation on a certain day, they're like, oh, it doesn't hedge. But I think long term, over time, it could do it. But I like the gold Bitcoin combo because then you get the best of both worlds. Because gold is a little more of a true alt. It's does its own thing, but it's not gonna like go crazy in a bad way.
Mhm.
You always have the potential with
Yeah.
Bitcoin now. So the combo is interesting. I also thought somebody would put one out that's like Bitcoin minus gold for the haters, or the
Ah,
Bitcoin people who hate gold, and then gold minus Bitcoin. Um, you know, because there definitely some bad blood between those two,
there
even though
is
they have a lot in
gold
common.
bugs
They really
versus the Bitcoin bugs. It's just like the hodlers versus the Bitcoin. The gold bugs are
they
something to
have so
behold.
much in common. Like someone could
Oh yeah.
definitely bring them together, but they're competing with the same mind share.
I gotta say, I've been always, uh, pointing my nose up at people who are adamant gold bugs since the beginning of my career. And time again, they prove me right. They prove me wrong. That gold asset class keeps on crushing it. Like it's just an absolutely bonkers when you look at it from any reasonable angle, just the returns. Forget about the economic reasons why it should, why it shouldn't. It has delivered. It has delivered. It is a competitive asset class, and whether it continues to do so, I don't know. But they have been right, and I don't know. Bitcoin,
Speaking of people who've been right, the Alpha Architect team
yeah.
have gotten really right with their box ETF, right? And they're teaming up with our friend Mab as well on something new. What's going on there?
Yeah, I mean, this is a whole nother wing of innovation, which is let me help with taxes. So people who are sitting on a lot of gains, Wes is a white label, and he's seen people want to take their existing bulk of separate account stocks and move it into an ETF to be able to manage the taxes on it, because you can use the creation redemption process in creative ways on that front. DFA is a good example. I think it's DFA, forget the ticker, DFAC. If you look at the creation redemption, it looks like heartbeat trade is a tax trade. Normally it's like this and then like this. This one's like, it's like somebody going like, on speed or something. They converted it and then instantly just went wild with the washing machine. So I think what Wes is trying to do is say, instead of a separate account from a rich person or an institution who's using the ETF, why don't we open this up for anybody who wants to seed it? So we'll let all the like little fish in who want to do this, and then we'll move it into an ETF. I just talked to him before I was on with you, and I still trying to get my head around a little bit about what's hard for me to understand is just that now you're in this ETF with all these other people's stocks. That's what's new and weird. I can't quite crystallize that yet, but I'm working on it. But that's good. If something is new, sometimes it takes a little bit to figure. Buffer, same way. It took me a little ride to wrestle with the concept a little, but it's novel. Now his box ETF is basically using derivatives to track the, I think it was like a short-term treasury bill.
Yeah, T-bill.
But you don't get any income. So so again, creative. And there's been a couple filings since then to do similar things. So you are going to have if I went over psychologically earlier, there's going to be a whole wing of ways to help with taxes. So the specificity of this stuff is really getting wild. I mean, like I said, this is the most creative industry, or I'd say sub industry in the broader industry, in my opinion, in product design. And it's good at democratizing things that they see elsewhere and like, oh, let's bring this to the ETF market. So I'm not surprised, but I didn't think this would exist. I didn't like say this should happen. But I get it now in retrospect.
So
So
just flesh it out. Unless maybe we can all flesh it out together, but
yeah,
what exactly are they trying to do with this new ETF? What's the point? And then what's it supposed to do?
so you're moving somehow you're able to work with Schwab to you have to fill out a couple forms, but they'll move the stocks over to the ETF,
Okay, so
and
you're
you'll
an individual
essentially,
investor.
yeah,
You've got large capital gains on your
yeah,
own public equity portfolio,
hmm
right? And so this is a way to potentially crystallize those gains without having to pay the cap gains taxes on it, or to minimize those taxes,
defer them.
defer them.
You essentially defer them by putting them in this thing.
Or you can defer them by just holding them yourself.
So again, I had 5 minutes on the phone with him. That was one thing I didn't totally get, which is that, okay, if you're not dodging the tax, if you're not able to wash all the gains out, you move all your stuff. Why not just hold it in your account until you're ready to sell anyway?
I
Um,
think, by the way, this is me totally speculating. This is not advice. This is total speculation. But my sense was that you're able to put in your shares as part of the seed for this. And just like if you've got a mutual fund with capital gains and you want to transition it to an ETF, there is a way to do that without crystallizing those gains. Then once it's an ETF, those gains can be rinsed through the create redeem process, and effectively those gains go away and you're sort of starting fresh.
Yeah. So I'm just reading here the kind of the top
but
line, which is,
what you just described though is a dodge, and he was adamant you aren't dodging, you're just deferring them, which is where I got a little lost. Like I said, I need to have another because I've read 2 articles on it, talked to him, and I'm still not totally understood. If what you said was true, that's what looked like happened with DFA. They converted and they start to wash. But that doesn't sound exactly that's what's going on here. Because he says you carry your tax basis over with you. And I say, well, can't they just wash away the gains? But he's like, no, you still have to pay when you. Anyway, I
right.
gotta. I don't want to give misinformation here. Like
No,
put a lot.
Yeah, no,
you
I
know, you
agree.
can
We're better
feed it
not. Yeah.
with,
What you said to me is what I thought it was.
yeah.
Right.
But then he pushed back a little, and I was a little lost at that point. Because then I was like, well, why would you do it then? So
Well,
I
yeah,
don't
I
know
mean, I
if you
think
guys.
you'll have to pay gains on any appreciation in ETF, right? So you seed it with your public shares,
Yeah, but if the ETF goes up, that's new. And
right?
in that example, you've washed out all of your old gains.
Yes,
But I
right,
don't think that's exactly what happens.
right. Okay, yeah,
Yeah. If that was it, that's I thought that was it, to be honest. So
yeah.
I
They'll have
gotta
like a $5 trillion
I think it
seed.
allows you to, if you have 2 or 3 big stock positions with a big capital gain.
America's ETF.
Can you guys hear me
Yeah,
okay?
Yeah, sorry.
Yeah.
Sorry.
If you guys like, if there's 2 or 3, 4 or 5 ETFs that have massive capital gains and you want to get off them, you want to reduce your position, you're terrified that you can't sell them because they're so concentrated. You seed this ETF and they swap your positions for the ETF's quality and value position kind of portfolio. And I think somehow you get that you're still on the hook for the capital gains. You're just not paying to get out of those risky positions into a more diversified portfolio.
okay,
That's
yeah,
it.
that
That
makes
makes
sense.
sense. That's a little less powerful than what you said and I thought, though, in my opinion.
Yeah.
Because I'm thinking you
Right.
put all your stuff in there, they wash it out, then you just sell tax at a small gain if it even went up at all 2 months later.
Wes is going to be watching this, just pulling his hair out, saying, "What the hell
Oh,
are
for
these guys
sure,
doing?"
for sure.
I know.
Mav's
Well, no,
gonna-
he kept saying, though, it's not a dodge, it's a deferral.
yeah, yeah. I think
So,
Yeah, yeah, yeah. So if you've got
but
concentrated stock positions and you've been looking for a way to sell those in order to
yeah,
diversify
yeah,
your portfolio,
yeah, there's
then this
another
is the
thing
way
there.
to.
That's the other
Right,
variable. Yeah.
right.
So,
Gotcha.
we'll have to get
so
Okay.
Mav and Wes
anyway,
on the pod to clear that one up. Very interesting,
yeah,
actually. I mean, that's the type of innovation that we're seeing in this industry. It's
Yeah.
you think that finance is
it's
not
endless,
creative, but it certainly is.
relentless.
Awesome, Eric. We've kept you now for an hour. Really appreciate your time. Is there anything that any parting words, anything that we haven't covered that you want to get off your chest?
Not really. Obviously, you guys, we can't talk about your funds, but congratulations.
Thank you. Thank you.
Yeah.
Thank you.
I had Corey on my podcast like
Billions, yeah.
6 weeks ago or so. So, yeah,
Definitely tune into trillions, just like billions with way more sex.
that's right. I actually way less because it's about the passive indexing. It's gonna be.
Yeah.
It's gonna. I'd have to think that. Yeah. But yeah. Anyway, good to talk to you
Where can
guys.
people find you, Eric?
You can couple of places, LinkedIn, Twitter, and then the podcast Trillions is free, so you could just like go to Spotify or wherever and get me there.
Yeah, it's a
Those
great
are
little
free
podcast.
ways to
Eric,
get me.
we got to ask
Great
where
production
can we
value.
not
You
find
guys are so sophisticated. You may actually have terminal clients listening to this. which is rare for me. Normally I'm on like some whacked out crypto podcast with like just nobody even knows what a terminal is. Anyway, BI ETF Go is where the real stuff goes. I mean, that's like the whole enchilada right there. So if you have a
Yeah.
terminal, there's a lot of goodies on there.
Nice. Okay.
Yeah.
So anybody with a terminal can go there.
Yeah.
And then, of course, Eric has written a book recently, The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. I would highly recommend going to Amazon and downloading that book or through your Kindle or getting it. I mean, I don't know. Are you doing signed copies there, Eric? You send those out to
Yeah.
audience
If
members?
somebody
So,
wants one, sure. Yeah. They can just
no.
reach out. Look, man, these types of books are, they're not hitting the New York Times bestseller list. So as a small time author, I'll do whatever.
And they're a lot of
That
work.
said,
They're a lot of work, and it's actually
it's got,
very, very entertaining. So
yeah.
very
And
insightful.
this dude was just weird and fascinating. And, I think worth a look, but, yeah, I worked hard on it. So, but I appreciate the plug and, good to talk to you guys.
Awesome.
You too,
Thanks,
brother.
Eric. Thanks for coming.
All right.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.